Hello everyone and welcome back to my channel. Today we have a fascinating topic to discuss. The recent bearish stance taken by Michael Burry, the famous hedge fund manager featured in The Big Short. Many of you might be wondering whether you should care about his views on the market. Well, we've got some valuable insights to share with you. So if you're ready, let's dive into it. First and foremost, let's talk about the media's role in all of this. When it comes to Wall Street, there's always a lot of noise. Most of it is mundane, but the media thrives on attracting your attention. They often report on famous investors like Burry, much like they do with Warren Buffett or Carl Icahn. But here's the catch. Just because a news article is written about them doesn't guarantee that the information is valuable. So you need to approach this with a skeptical mindset. Here are a few tips for approaching news articles about investors. 1. Consider the source. Is the article published in a reputable news organization? Is the author a credible journalist? 2. Beware of sensational headlines. The media often uses sensational headlines to grab attention, but these headlines may not be accurate or representative of the full story. 3. Read the entire article. Don't rely on just the headline or the first few paragraphs. Read the entire article to get the full context of the story. 4. Be skeptical of claims. Don't just believe everything you read. Be skeptical of claims made by investors, analysts, and the media alike. 5. Do your own research. Don't make any investment decisions based on a single news article. 5. Do your own research and consult with a financial advisor before making any investment decisions. The second point to remember is that famous investors, even someone as renowned as Warren Buffett, have their fair share of mistakes. For example, when Buffett bought Berkshire Hathaway in the 1960s, it was a textile company. He couldn't save that business and eventually had to shut it down. The point is, famous investors are not infallible. They make educated guesses at best. Just like the rest of us, the story of Berkshire Hathaway is a reminder that even the best investors make mistakes. It's also important to remember that famous investors have different investment styles and philosophies. What works for one investor may not work for another. It's important to do your own research and develop an investment strategy that is right for you. Here are a few tips for developing your own investment strategy. 1. Consider your investment goals and risk tolerance. What are you hoping to achieve with your investments? How much risk are you comfortable with? 2. Educate yourself about different investment options. There are many different types of investments available, such as stocks, bonds, and mutual funds. Learn about the risks and rewards of each type of investment. 3. Diversify your portfolio. Don't put all your eggs in one basket. Spread your money across different types of investments and industries. 4. Rebalance your portfolio regularly. As your financial situation and investment goals change, you may need to rebalance your portfolio to make sure it still meets your needs. Now let's discuss what Michael Burry is actually doing. Market timing. He's made some substantial bets on the market going down through options trades, but this is a high-risk, high-reward strategy. Market timing involves predicting the market's direction, and very few people have the financial capacity or temperament to make such aggressive bets. Diversifying your portfolio is a safer approach to protect against significant losses, despite gaining notoriety for his role in The Big Short and his assessments of the 2008 housing market. It's important to note that Michael Burry has a history of making inaccurate forecasts. He has a track record of retracting many of his predictions, especially since 2015, where the S&P 500 has consistently delivered positive performances following his bearish calls. Here's a recap. 1. In December 2015, he forecasted a stock market crash in the coming months, but the S&P 500 actually saw an 11% gain over the subsequent 12 months. 2. In May 2017, he predicted another financial collapse, yet the S&P 500 recorded a 19% increase in the following 12 months. 3. In September 2019, he projected a stock market crash linked to an indexed ETF bubble, but the S&P 500 gained 15% in the next 12 months. 4. In March 2020, he consistently held a bearish view, but the S&P 500 surged by 72%. 5. In February 2021, he anticipated significant stock market declines due to a speculative bubble, but the S&P 500 increased by 16% in the subsequent months. 6. In September 2022, he predicted further market failures and claimed that the lows hadn't been reached, but the S&P 500 performed positively with a 21% gain. 7. In January of this year, he foresaw a recession and a new cycle of inflation, Yet the S&P 500 achieved remarkable positive performance. Given this historical context, it's wise to consider Burry's recent bearish stance with caution and skepticism, given his history of retracting inaccurate predictions. Instead of reacting to the latest news or the moves of famous investors, consider sticking to a well-thought-out long-term investment plan. Whether it's investing in balanced funds or following Warren Buffett's advice of buying great companies at reasonable prices, consistency in your approach is more likely to lead to success. The stock market can change over time, so it's important to make sure that your investment plan is still aligned with your goals and risk tolerance. Here are a few additional tips for long-term investing success. 1. Don't panic sell. 1. The stock market can be volatile in the short term, but it has a history of trending higher over the long term. 1. If you see your investments decline in the short term, don't panic sell. Stay calm and stick to your long-term investment plan. 2. Invest regularly. One of the best ways to grow your wealth over time is to invest regularly. This could mean setting up a monthly investment plan or contributing to a retirement account on a regular basis. 3. Don't try to time the market. It's impossible to predict when the stock market will go up or down. Trying to time the market is a risky strategy that is likely to lead to losses in the long term. By following these tips, you can develop a long-term investment plan that will help you achieve your financial goals. So in conclusion, while it's exciting to follow the actions of famous investors like Michael Burry, it's generally not advisable to base your investment decisions solely on their moves. Remember that financial news can be sensationalized. Famous investors are not infallible, and market timing is risky. Focus on a long-term strategy that aligns with your financial goals and risk tolerance, rather than chasing the latest trends. If you found this information helpful, please give us a thumbs up and subscribe for more valuable content. Thanks for watching, and we'll see you in the next video.